Hi, I'm Daniel Brereton, Director of Investor Relations here at EquityMultiple. Today we'll be talking through risk and return and what those mean for real estate investors. For most investors, risk and return are the key focus points when evaluating an investment. In an ideal world, we would be able to get exactly the return we want without needing to take any risk. In reality, however, risk and return are a trade-off for investors. An investment's potential return is often easy enough to understand. It's the amount of money or value we anticipate to gain from the investment, whether that be yield and periodic cash flow or capital appreciation from the investment gaining value. Risk, however, is often less well understood, and typically it's hard to quantify. As a real estate investor, it's essential to understand the various risks associated with investing. Professional investors see risk in two broad buckets. The first are idiosyncratic risks. These are risks that are specific to a particular investment and are related to its unique features and performance. By diversifying your portfolio, you can often reduce exposure to idiosyncratic risks and potentially diminish the impact of a single event's negative impact. The second bucket are systematic risks. These affect the entire market and include things such as changes in interest rates, economic recessions, or geopolitical events. These risks can't be diversified away and are inherent in the market. Economy-wide shocks or black swan events are the clearest examples of systematic risk. The global financial crisis of 2008 or the outbreak of COVID-19 are clear examples. As I mentioned before, idiosyncratic risk refers to the risk that an investment will experience a decline in value due to factors that are unique to that particular investment. These risks include things like natural disasters, poor management decisions, or unexpected changes in the market. We'll discuss some specific types of idiosyncratic risk next. The first type is financing risk. This is the risk that the capital structure of a particular offering could pose a threat to the return prospects of the investment, particularly if conditions change. If the sponsor or borrower is operating at a high loan-to-value or high loan-to-capital, or at a low debt service coverage, this risk could be heightened. Floating rate debt could also be a risk, especially if interest rates are on the rise. Another is construction risk. This is the risk associated with construction projects, including the possibility of delays, cost overruns, and construction defects. Tenant risk is the risk associated with tenant turnover, including the possibility of lease defaults, evictions, and property damage. The specific market or submarket can have their own risk beyond the general macroeconomic risk. The metro area or specific neighborhood the asset may pose idiosyncratic risks. A lack of diverse demand drivers, that is, over-reliance on one industry or employer, could pose risk. Crime or environmental issues could also pose various other risks. These are typically much lower in Tier 1 markets and established neighborhoods, such as much of Manhattan. On the other hand, investors are typically rewarded in terms of return potential when investing in less established neighborhoods that may be gentrifying or increasing in cachet. Additionally, all private market commercial real estate investments pose some degree of liquidity risk. These investments are, by definition, illiquid. However, investments will entail varying degrees of liquidity risk. Some with shorter terms and more certain cash flow will entail less liquidity risk. For example, a senior debt investment secured by the underlying property is one example of a lower liquidity risk. Conversely, a ground-up development investment with an uncertain timeline will entail significantly more liquidity risk. The return potential should be appealing, the timing of your principal repayment will be very hazy. The risk that the GP or sponsor will fall short in execution of the investment's business plan is known as sponsor risk. You can reduce this form of idiosyncratic risk by investing alongside highly vetted sponsors with an established track record and good reputation. Just like the public markets, private market investments entail idiosyncratic risk, but also hold idiosyncratic return potential. Because private markets are slow-moving and less efficient than public asset markets, real estate sponsors can derive returns from buying at the right time, selling at the right time, and a unique experience within a market or type of business plan. Real estate investing offers significant opportunities for investors to achieve higher returns than traditional investment vehicles like stocks and bonds. However, as with any investment, there are risks involved, and investors need to understand how to manage these risks to maximize their returns. If you're interested in learning more about real estate investing, sign up for a free account on EquityMultiple.com. Our platform offers investors access to a variety of investment opportunities. EquityMultiple also provides tools for making informed investment decisions. Our investor relations team is standing by at ir@EquityMultiple.com or by using the chat feature on our website. Happy investing.